Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the deep dive. You know, when you hear that a major corporation has filed for bankruptcy, the natural assumption is that it's over.
Right. It's the end of the line, a complete failure.
A corporate funeral, basically.
And look, for some companies, that's exactly what it is. But the material we've pulled together for today, it really shifts that whole perception. We're going to look at corporate bankruptcy, not just as a failure, but as a kind of sophisticated and, very painful financial strategy.
So a tool.
A tool for radical restructuring. Sometimes it's the only tool they have left.
And that's our mission for this deep dive, to give you a really structured look at financial distress. We're going to break down the mechanics.
The two main paths, the strategic moves that happen behind closed doors, the amazing recoveries, and of course, the total collapses.
Because understanding how all this works under extreme pressure, well, that's fundamental to understanding corporate finance at the highest level. Okay, so let's start with the absolute basics of, U.S. corporate failure. There are basically two doors a distressed company can walk through, and the outcomes are just polar opposites.
Completely different.
Door number one is Chapter 7.
Chapter 7 is the final curtain. That's it. It's liquidation, pure and simple.
So what happens?
The minute a company files Chapter 7, it just ceases all operations. Everything stops.
Immediately.
Immediately. A trustee is appointed, and their one and only job is to sell off every single asset the company owns.
Everything. The machinery, the buildings.
The patent portfolio, the chairs, the desks, everything. And that money is used to pay down outstanding debts.
A total corporate demise. So creditors get pennies on the dollar, and I assume the stockholders, the investors, are just wiped out.
Completely wiped out. The business is gone forever.
Okay, so that's the end. But the second path, Chapter 11, that sounds like where the real strategy comes in.
Oh, absolutely. This is the high-stakes drama. Chapter 11 is reorganization. It's a court-supervised process, and it's designed to do one thing: allow the business to survive. It gives management this massive shield. It halts all creditor lawsuits, which gives them breathing room to, restructure their finances.
So it's like a corporate reboot button. The lights stay on, people still come to work.
Sometimes, yeah. Business as usual on the surface, but behind the scenes, the goal is radical surgery on the balance sheet.
So what are they actually trying to do in that protected bubble?
Their goal is to emerge as a viable company. They have to renegotiate huge debt burdens, get rid of unprofitable divisions/costs, and crucially, find new money.
Right.
Chapter 11 lets them do things that would be totally impossible otherwise, because for a time, the court's power is greater than the power of all their old contracts and creditors.
When you look at the research, it seems like bankruptcy is almost never this single, oops, we ran out of money moment.
No, it's never just one thing. It's more like a systemic disease than a common cold.
So what's the mix?
The sources all point to a dangerous combination. It often starts with excessive leverage.
Too much debt?
Way too much debt, yeah.
Yeah.
Either from a big buyout or just aggressive expansion. Then you combine that with some major industry disruption, bad operational decisions, or a big macro shock.
Like a pandemic or a financial crash.
Exactly. And in simple financial terms, what happens is the company's capital structure just collapses. It can't generate enough cash to pay the interest on its debt.
And that forces the creditor's hand.
And that's what triggers the biggest financial maneuver in Chapter 11, debt renegotiation. The debt load is just impossible, so creditors are forced to take a haircut. A painful one.
But here's the part that I find fascinating. The debt isn't just forgiven. It's often converted.
Yes. This is the critical strategic twist. The debt is often converted directly into equity.
Okay, let's just pause on that for a second, because that's a huge deal.
Yeah.
The people who loaned the money, the bondholders, they suddenly become the owners of the reorganized company.
They do.
Doesn't that just completely change the company's DNA going forward?
It absolutely does. I mean, think about it. You've taken the most risk-averse people in the entire capital structure.
The people who just want their money back with interest.
Exactly. People focus purely on safety. And you've made them the equity owners, the ones who are supposed to be cheering for growth and taking risks. That tension can define the company's strategy for the next decade.
So they'll prioritize stability and paying down debt over, say, aggressive expansion.
That's the theory. It's a huge shift.
So to even get to that point, a company needs cash. right now. How does a business that just declared bankruptcy convince anyone to lend them more money?
That is the multi-billion-dollar question, and the answer is something called DIP financing, debtor-in-possession financing.
Okay.
Nobody wants to lend to a sick company, right?
Okay.
So the court gives this new debt what's called super priority status.
Super priority.
It means it jumps to the very front of the repayment line, ahead of every single pre-existing creditor. The DIP lenders are guaranteed to get their money back first.
I have to imagine that creates some pretty intense conflict with the old creditors who just got pushed to the back of the bus.
Oh, intense is an understatement. It creates enormous friction. But that new financing is the company's lifeblood. It's what keeps the lights on while they do the surgery.
And Chapter 11 is also where they can shed all those other burdens, not just financial ones.
Yes. This is the surgical part. With court approval, companies can just cancel or break expensive long-term contracts.
Like what?
Think about all those legacy store leases that are bleeding cash, or unsustainable deals with suppliers, or even, and this is very controversial, union labor contracts.
So it's a way to wipe the slate clean of decades of bad decisions.
It is. And that leverage, that ability to shed structural costs is the core reason Chapter 11 lets companies like, say, an airline or an automaker emerge so much healthier.
And when you look at the case studies, the difference between the companies that really used Chapter 11 well and those that were, just too far gone,
Wow.
it's dramatic.
Light and day.
Let's start with the success stories. The companies that were reborn.
General Motors in 2009 is probably the ultimate example. It was a perfect storm of surgical restructuring and, of course, government support.
So what did they do?
They used Chapter 11 to do more than just cut debt. They systematically eliminated entire brands that were unprofitable.
Pontiac, Saturn.
Gone. They drastically reduced their number of factories and dealerships, and they shed these staggering legacy pension and healthcare obligations, and they did it incredibly fast.
And then you have Delta Airlines, who ran a similar playbook, right?
Very similar. Their bankruptcy let them tear up all these restrictive aircraft leases and labor contracts they'd signed in better times. They restructured billions in debt and completely rebuilt their route network. They became a profit machine for the next decade.
There are also these more, creative successes, like Marvel Entertainment in the 90s.
That's a fantastic one. They were financially broken, but the restructuring allowed them to do one crucial thing: regain control of their own intellectual property.
Your characters.
Their characters. And that led directly to their pivot toward film and licensing. It was a failure of finance that, it enabled a massive success of strategy.
And even more recently, Hertz. During the 2020 pandemic, everyone thought they were finished.
They looked like a surefire goner, but they successfully restructured right as the used car market went completely insane. Bankruptcy gave them the time and protection they needed to wait out that macro shock.
So now let's look at the other side, the collapses, where the problems were just terminal.
Right, where the financial mistake was lethal. And you have to start with Lehman Brothers in 2008.
The largest U.S. bankruptcy in history. The one that basically triggered the global financial crisis.
That failure was all about excessive leverage that was hidden off the balance sheet and toxic exposure to assets nobody wanted, mortgage-backed securities.
So why couldn't they reorganize like GM?
There was no credible path. The debt hole was just too deep. The assets were worthless under pressure. And crucially, no government was willing to step in and backstop the risk.
And then there's a really painful one. Toys R Us.
A very painful example of structural decay made worse by financial pressure. The sources are clear on this. The huge debt from their private equity buyout meant they had zero capital left.
So no money to invest in. A better website.
Exactly. No money for e-commerce, no money for modern warehouses to compete with Amazon and Walmart. The debt just created this operational choke point that ultimately led to liquidation.
And the classic failure to adapt story, Blockbuster.
Oh, yeah. Their whole business model was built on fixed costs. Thousands of physical stores, all with long-term leases.
A huge anchor.
A massive anchor. When digital streaming came along, their revenue just vanished. But those fixed costs didn't. And Chapter 11 just wasn't fast enough to let them escape that weight.
Which brings us to what this actually looks like on the ground. For the finance teams and the advisors, navigating a Chapter 11 isn't some academic exercise.
No, it's a fight for survival. It's probably the ultimate test of operational finance.
And the focus shifts entirely to one thing.
Cash flow triage. That's it. Teams are monitoring liquidity not just daily, but sometimes hourly. Every single payment is scrutinized.
And you're constantly prioritizing.
Constantly. Payroll is always first. Then your absolutely critical vendors, the ones you need to keep the lights on. And finally, making the required payments on that super priority DIP financing.
You mentioned the model for this is the 13-week cash flow model.
That is the absolute backbone of the entire reorganization. It forecasts every single dollar in and every dollar out, week by week, for the next 3 months.
It has to be perfect.
It's basically treated like a legal document because if the company misses its cash flow forecast, even by a little, for 2 weeks in a row, the DIT lenders usually have the right to just pull the plug.
Wow. Which forces liquidation.
Instantly. The pressure on the modeling team is just immense. It's not forecasting, it's a commitment.
And that discipline is essential for managing all the stakeholders, right?
Vital for stakeholder management. You're dealing with all these conflicting interests. The banks, the bondholders, the vendors, unions.
And the finance team's credibility is what holds it all together.
It's everything. If your numbers are soft, if they don't trust you, the whole thing falls apart and you're pushed into Chapter 7.
Okay, so let's put this into a checklist for our listener. If you're evaluating a distressed company, trying to figure out if it's a future GM or a definite blockbuster, what do you look for?
The sources lay out 5 critical questions. First, what is the liquidity runway? I mean, how many months, weeks, or even days can they survive before the cash runs out?
Second, the debt load. Is the hole just too deep, or is the capital structure actually salvageable?
Third is a core operating question. What are the unit economics? And what we mean by that is, if you strip away all the legacy debt and other costs, does the core business actually make money?
Is the product itself profitable, or is the whole concept broken?
Exactly. Fourth, is there a credible turnaround plan? And more importantly, is this the management team that can actually execute it?
And
What's the asset value? If this all goes wrong, can the company sell off divisions or real estate or patents to cover a big chunk of its debts? These questions, they force a very brutal, very realistic assessment of a company's chances. So I think what we really hope you take away from all this is that bankruptcy is rarely a passive event. It's financial strategy under the highest pressure imaginable.
Right. It demands this mastery of debt valuation, cash flow modeling, operational triage.
Skills that are critical for any big strategic pivot, really, even for healthy companies.
It comes down to this. Some companies die and some are reborn. And the difference, as all our sources point out, often comes down to the quality of the financial modeling and the clarity of the teams working inside that pressure cooker.
Which brings us all the way back to that provocative idea we touched on earlier.
Right, about the bondholders becoming the new owners.
Exactly. We noted that the bondholders, who by nature prioritize financial stability, they often become the majority equity owners in a restructured company like a Delta or a GM. Their focus shifts from, the usual equity playbook of maximizing growth and taking risks
To just ensuring stability and generating cash flow.
to get their original investment back.
So here's the final thought for you to mull over. When a company goes through Chapter 11, the entire process is designed to create a healthier, less indebted version of itself. But if the company's new majority owners are structurally, fundamentally averse to risk, does that necessary surgery inadvertently stifle the company's long-term appetite for innovation? Does it make the reborn company safer, but maybe less dynamic?
That's a huge strategic question for any investor looking at a post-bankruptcy company.
Something to think about until our next deep dive. Thanks for tuning in.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.